welcome back to the stage our MC, Patrick Huey.
Hello, everybody. We are back after a quick break. We have a great keynote session we're going to talk about the performance of luxury hotels now and looking ahead. And we have Romy Bhojwani, who is the Director of Hospitality Market Analytics for CoStar Group. Thank you, Romy.
Good afternoon, everyone. Great to be with you today. Great to be back at Inspire. This is my 5th Inspire conference, one of my favorite industry events of the year. So thank you, ILHA, for the opportunity. I'm Romy Bhojwani. I'm with CoStar Group. CoStar is a global data analytics company, and we're also the parent company of Smith Travel Research. In addition to STR, we also have about 16 other commercial real estate brands. So besides hotel data, we have insight into office, multifamily, retail, industrial, and a whole host of other commercial real estate asset classes. So today we're going to talk about state of the U.S. lodging industry, and we'll focus specifically on hospitality. But I want to spend more time talking about the future. Next year, what does that look like? Are we forecasting a recession? What happens to hotel demand? And what is going to be the impact on luxury hotel travel? So let's dive right in. And by the way, I apologize in advance. We're going to cover a lot of data today, and I'm going to move through some of the slides quickly, but the presentation will be made available to you. So please feel free to reach out with any questions that you may have, and happy to follow up with you as well. So where are we today? We'll talk about U.S. lodging and luxury class RevPAR and profitability. Where are we headed? Are we forecasting a recession? How severe? What is the typical relationship between a recession and the impact on hotel demand, particularly on luxury hotel demand? And is this time different? What can we expect over the next 12 to 18 months? And then finally, we'll end on our forecast for U.S. RevPAR and demand, and also for the different chain scales. So where are we today? RevPAR is up 7% through year-to-date October. ADR is up 13%. And room demand is essentially back because supply is up 3% and demand is down 3%. So those cancel each other out. So we're essentially back at the same level of hotel demand in terms of room nights sold compared to 2019. This is a rate-driven recovery. Since March of this year, we have had double-digit ADR growth every single month compared to 2019. And over the past couple months, September and October, we've been right at that 17% ADR growth. Now, this is nominal ADR growth, what you see in your actual STAR reports and your P&Ls. This is not adjusted for inflation. So when you adjust for inflation, what we call real ADR, that has been right at that 100% level, fully recovered after factoring in for inflation ever since March. So we're stable at that 100% recovery adjusted for inflation most of this year. It's a very, very strong ADR growth. And when you compare how ADR has trended in this cycle compared to prior recessions, it's even more incredible. When you look at the 2001 recession, it took the industry 6 years to get back to pre-recession inflation-adjusted ADR. When you look at the 2008 recession, the great financial crisis, it took the industry 8 years to get back to inflation-adjusted ADR. Post-COVID-19, it's taken the U.S. lodging industry 28 months to get back to pre-recession ADR. Just incredibly strong ADR growth. Honing in specifically on luxury, so just a global view, with the exception of Asia Pacific, all major regions across the world are fully recovered in terms of luxury RevPAR. The Americas up 14%, Europe also up 14%, Middle East and Africa 18%, and Asia Pacific, obviously, with China just starting to open up. Other Asian economies were closed for most of this year, down 28%. Luxury demand has fully recovered over the past couple months. We're up 1.5% compared to 2019 in terms of luxury room nights sold relative to pre-pandemic, the same month pre-pandemic. Luxury room rates are at an all-time high. When you look at nominal luxury ADR, we've been at just around that 28% growth relative to 2019, so significantly above inflation, almost 3 times the run rate on inflation. And when you compare luxury to the other classes, luxury is leading the rate recovery. We're at 126% index to 2019 on nominal ADR and 109 on inflation-adjusted ADR, and so much higher than all of the other hotel classes. So it's really luxury has been driving the rate recovery in our industry. When you look at profitability, with the exception of the independent chain scale, luxury is on top of the list in terms of total RevPAR, indexed to 2019, as well as GOP per available room. And our friends from Hotstats touched upon this as well. Total RevPAR is at 104%, indexed to 2019. GOP per available room is at 106%. So we're ahead on the top line in the luxury segment, and we are more profitable compared to 2019. In terms of segmentation, group versus transient, group has been a bright spot in this recovery. Very strong momentum on the group side. We are, as of October, we were 97% recovered in terms of total group demand relative to 19. We're seeing a lot of momentum in terms of pricing power on the group side as well. So transient RevPAR has been ahead of 2019 since February of this year. Group RevPAR exceeded 2019 since August of this year, and it's quickly catching up to transient RevPAR. So that's where we are today. That's a recap of all the key metrics on how the luxury hospitality industry has performed. What about going forward? So looking ahead, I wanted to frame the forward-looking view with 3 key questions. Are we headed for a recession? What is the typical relationship between hotel demand and negative GDP growth, a recession in the US? And is this time different, and why? So before I answer each one of those questions, I wanted to frame the context around the correlation between GDP and hotel demand, and the last panel touched upon this as well. In every single recession that we've had in the US, hotel demand has declined. There is a very strong correlation between GDP growth in the US and hotel demand. And it's even stronger specifically for luxury. So, and this goes back 30 years. Since 1990, that's been the case. And hotel demand is actually pretty sensitive to GDP, and it declines almost 4 times every time there is a 1-point drop in GDP. So in terms of, are we going to have a recession? We get our economic data from Tourism Economics. They're our partners for STR and CoStar, and they're forecasting a mild recession for next year, with GDP down 1 point in 2023. When you look at that forecast relative to other recessions, it's pretty mild. It's only 1%, whereas in 2008 we were at more than 4%, and certainly in the prior recessions quite a bit more than that. So the forecast is a mild recession of 1%, likely going to occur in the second half of next year. So in terms of the relationship between a recession and hotel demand, over the past 3 recessions, obviously you can take 2020 out of it because that was a public health situation. But if you look at an economic recession, every time there's been a GDP decline, hotel demand has declined by 4 times. So a point in GDP is 4 points decline in hotel demand. So very, very sensitive to economic changes. Luxury is particularly sensitive at 5.2%, followed by upper upscale at almost 5%, and it gets a little better in the middle of the chain scales, and then mid-scale and economy right at that 3.5 to 4.5%. In terms of ADR, that relationship is even more pronounced. So luxury sees the largest decline in a recession. Luxury ADR drops 7% with a 1% drop in GDP. So unfortunately, luxury is highly correlated to an economic recession. So how is this time different, and is this time different? So our view is that that relationship between GDP and hotel demand, there's going to be a divergence there in 2023. I think for the first time we will see hotel demand grow during a recession. And let me lay out the case why that is. So one is we're seeing a lot of shifts, just fundamentally different environment for luxury travel that is going to continue to drive growth in the luxury segment. One is we're not seeing any signs of weakness yet, year to date, as well as the forward-looking demand. You saw from the previous slides, ADR continues to grow, demand continues to grow, group is not fully recovered, and business travel is also not fully recovered. And not all business travel is luxury-oriented, but it helps provide compression to luxury, particularly in urban markets. Air transportation, which is a big driver of travel and certainly luxury travel, in terms of capacity, we're only at 95%. So there's still some runway there. As airlines get more seat capacity going, there is more demand that will create as a result of that additional capacity being made available. And then international travel is not yet fully recovered. China and parts of Asia are just starting to open up. Through mid-year this year, international inbound was only 65% recovered. And international outbound is 75% recovered, and that we think that has a lot to do with the strength of the dollar and how much further your vacation dollars go if you were vacationing in Europe or Mexico, Caribbean, that type of thing. But we think this is a very significant tailwind for luxury travel. With China just opening up, China is the #1 exporter of tourism to the United States, by far. And China is just opening up. So that demand is going to come back. A lot of that is luxury-oriented. A lot of that is in urban markets, resorts. So we think there's a lot of runway to be had in terms of international travel coming back to the U.S. Number 2, U.S. households and corporations have never had this strength of balance sheet, whether it's household balance sheet or corporate balance sheet, and just the level of cash available for spending. We know this has been a historical stimulus in terms of how much money supply there has been in the economy, and that is giving corporations and consumers unprecedented spending power. So household debt service is pretty close to all-time lows, and household net worth, with the run-up in real estate values that we've seen, pretty significantly greater than prior years, and also close to all-time highs if you go back almost 15 years. And the cash available that we talked about, the stimulus. So if you think about 2008, the quantitative easing, the stimulus that was provided to the US economy was worth about $950 billion. And you think about the stimulus that was provided post-COVID, it was $6 trillion. So it's really 6 times the amount of stimulus compared to 2008 that is in the system, that's money supply, and a lot of that is still available to be spent by both individuals as well as companies. And corporate balance sheets and corporate profit margins are at an all-time high as well. And this is what's really different compared to the 2008 recession. In 2008, company balance sheets were strained. There was financial distress in the system. But that's not the case now with most companies. Profit margins are extremely high. A lot of that has to do with inflation. Unemployment is at an all-time low. And productivity has gone up over the years in the US economy. So companies are feeling good, as is the consumer. And employment obviously is a very big driver of travel and as well as luxury travel. And you can see unemployment, we know, is at an all-time low, but employee compensation is close to 15% higher than pre-pandemic levels. And this is the whole, the war for talent, right? When people are looking to fill those positions and retain people, they are paying more to do that. And employee compensation is at 15% compared to the run rate on inflation of 11.5%. So very significant tailwind to travel, and particularly luxury travel. And then you've heard throughout the conference, even yesterday, the prioritization of travel, the experiential travel specifically, and aspirational luxury, we think is a long-term trend. There are more people, just given the demographic shifts with the Gen Z and the millennials, there are more people looking for luxury experiences, and there's more loyal luxury customers looking to trade up to more unique and exclusive experiences. So the overall momentum for luxury is very strong, given what's going on from a demographic perspective. And we think this is a long-term trend. This is not a post-pandemic blip for a year or two. This is a longer-term trend. And you can see that in the data from a spending perspective. Early in the pandemic, most of us were at home, locked down. We were spending money on products and goods, buying the Peloton bikes and the treads, and it was more product-related spending early in the pandemic. More recently, that spending has shifted to services and experiences. And that's giving travel even continued momentum as people reduce spending on goods and products and shift the spending to services. So that number, the spending on services, continues to grow month over month. And then when you look at the travel sentiment, Miles and Longwoods does a monthly traveler sentiment study. It's pretty exhaustive, pretty comprehensive, and that the forward-looking intent to travel has stayed at that 90+% range for quite some time now. So consumers are not feeling like they have to pull back. Leisure, business travel is starting to recover as well. So this is a pretty significant. At 91%, that's pretty high when you look at the historical averages. And then finally, the work from anywhere and hybrid work that's a trend that's here to stay for some period of time. A lot of companies tried getting people back. We did as well at CoStar, 5 days a week. Very low compliance at that level. Then we shifted to 4 days a week, also low compliance. and now we're at 3 days a week. This is here to stay for some period of time, and we can see from the data that more remote and more hybrid work directly translates to more travel. People are working from cities outside of their homes. They're traveling to new destinations that they haven't seen before. They're traveling for leisure. They're getting out of town on a Thursday or a Friday, working from the hotel, getting back to work on a Monday or a Tuesday. And so those numbers have gone up pretty significantly. So this is a study. If you follow Nick Bloom at Stanford, he's probably one of the more forward-thinking guys in research on work from home. So their most recent study has 2/3 of all office jobs are now hybrid, is what the data says. So that's a lot of demand for travel that did not exist previously. These were, when people were in their offices 5 days a week, they were only traveling on weekends. And now you can, we see it in certain urban markets, right? When Thursday used to be the biggest checkout day, and now Thursday is a big check-in day. So the work from anywhere and the hybrid movement is fueling a lot of travel, and particularly luxury travel, right? Because these are folks that are not staying at a Hampton Inn, they're not staying at a mid-scale hotel, they're staying at more experiential, independent lifestyle and luxury properties. So what does that all mean for our forecast? So we just updated our forecast with the new macroeconomic numbers, some of these trends that we're seeing from our own data and other partner data sources. So for 2023, we're essentially at about 112% RevPAR index to 19. So we're at 12% above 2019 from a RevPAR perspective. Most of that is coming from ADR growth. We'll be right at that 100% index on occupancy, and about 15% higher than 19 on rate. From a chain scale perspective, luxury is right under 5% RevPAR growth for next year. Upper upscale is at 9.5% growth. That's because upper upscale is starting from a much lower baseline this year. So that's why the year-over-year growth next year is much stronger, 9.5%. Upscale is at 3.8%, upper mid-scale at 2.4%. But we're not projecting growth for economy and independence. We think those segments will be flat year over year in 23. And when you look at the actual growth rates, so what this all means is RevPAR will be up. Our forecast is RevPAR will be up 3.5% next year, about evenly split between occupancy and ADR. Occupancy at 1.7, ADR as well at 1.7, and demand will actually grow 2.8%, even though we're going to be in a recession, at negative 1% GDP growth. So I think we're going to see, for the first time in 30-plus years, the trend of the high correlation between GDP and hotel demand. There will be a disconnect, and we will have hotel demand grow even in a recession next year. That's our current view. So again, I know I went through a lot of the data quickly. These slides will be made available to you, but I'm happy to take any questions.
We have a question here for you.
It's a question from the audience. I'm not sure if it's virtual or in the room. I think the question is essentially asking, can you describe the process by which you are adjusting your nominal ADR to real ADR?
Yeah, great question. So when we get daily feeds from hotels and monthly data from all the brands, a lot of hotels across the country and the world. So what we do is we look at the inflation data with NBER, and we adjust it based on the actualized inflation for that month. So we'll roll up the ADR for the industry, we'll put the inflation number against it based on the economic data, and that's how we'll arrive at inflation-adjusted ADR. Any other questions? Great. Well, I'm around for the rest of the day if there's any questions that come up. And certainly, once you've had a chance to take a look at the presentation, feel free to reach out to me. My email's right there. But thank you for being here. Thank you for listening. And have a great rest of the conference.